You remember Leopold Aschenbrenner, this guy grows 1 billion to 5 billion in his first year of hedge fund. Look at that. He was praised everywhere. Everywhere. And something really bad happened to him. Citadel buys most of situational stock holding after AI share rout, sources say. And we're going to go deep into it because this is huge. So the AI fund that made 439% then had to sell. So that's the thing. Citadel acquired most of Situational Awareness public stock book after the July AI rout. And that's Reuters who talks about it as well. You're going to see that everyone is talking about it because there was a crash on the AI stocks recently. And maybe some people were behind that crash. So the paradox, right? The thing is, like, the guy was up almost plus 500%, insane performance. The early book was roughly $20 billion. And now it went down because it was with leverage. So it was trading with leverage. What it means in leverage is that you get some money that you don't have temporarily. So it's like borrowing. Like, you can borrow to buy a house, and then if the house market goes down and then the rent goes down, you can't pay back anymore, then the bank get back the house. Well, it's the same here in the financial market. You can trade with leverage. And our dear friend Leopold was doing with a little bit of leverage. He was at 4x leverage. So, for example, if he had $1 billion, he was investing with $4 billion. And it works really well when the market goes up. But when the market goes down, it's complicated. And that's what happened, actually. It's the market went down. And now what they did is they negotiated a whole book exit. So they say, oh, you're down, poor you. Well, don't worry about that. Don't worry about being down. Come to us. We're going to help you. So they bought back his stock. So Goldman Sachs, JPMorgan, Bank of America, and Citigroup helped facilitated the deal. So losses, financing pressure, raise capital or sell. Citadel buys broker finance portion. Boom. Directly like that. And the leverage spiral, so that's the thing. Larger growth exposure, prices reverse, equity cushion shrinks, and sell liquid positions. So when the positions start to get in the red, it gets even more in the red and faster. And if it touches a point where, well, the bank that lent you that money on your leverage is going to be boom, we sell. And that can create like cascade in the financial market. Like, if you check the Korean stock market, the KOPI index, it went crazy down recently. That's not that. The KOSPI index, which is back up almost 20% today as we speak. But if we check in the last month, minus 25%. This is a big dips that you can see in crypto. And that thing went up for a while, but now look at that, to 1,500 down to 1,000. And this creates, for everyone who has exposure, liquidation, sell, stop loss, and then you get something that's escalate. Actually, what is crazy is that 2 days, the stock market in Korea, they closed. They had a circuit breaker. They're like, no, this is too crazy. Schlag. They closed the market, which is normally only in big crisis moment. And now we see that like happening again here. So we had long shares, put notional and call notional. So in total, he had probably around 42 reportable position, which is total for 13.6 billion. That's the source from the SEC, by the way, because he was a big fund, so he had to share, where his long share value set. So he had Bloom Energy, SanDisk, CoreWeave, Iron, Core Scientific, and Applied Digital. We saw SanDisk dipping crazy, right? Look at that. You see that dip? Had a majestical dip here. Poof. And then suddenly going back up. So that's where they bought it. They literally created the bottom for them. They just like, they didn't care. They're like, boom. They literally, they saw the guy running. They tripped him. I was like, oh, poor you fell down. Don't worry, come up. That's exactly what they did on him. No respect. Absolute cinema. So there was like different positions. So we had Broadcom that only as a put. Intel had a large put and a much smaller common share line. CoreWeave appeared as ordinary share and calls. And this was complex relative value book, not a one-way basket. So there's like tons of different positions. You couldn't know exactly what you were buying and how you were buying it. So the thesis and the trade are different things. The thesis was like AI capabilities and infrastructure demand accelerate. The expression, which stocks at what price in what size, that's what they did. And financing, how long the portfolio can survive volatility. And liquidity, whether exits are possible without moving the market. And then you can be right about the destination and still be forced out on the path. This happened to me. I shorted SanDisk at $2,000, something like that. And it went up to $2,400. So I know I was at $2,200. I posted it in my Telegram. And because I'm a pussy, I had a stop loss at 2,400 or something like that. And I got stop lossed out. People telling me I was dumb to short those stocks. And I listened to them. And I missed out on a crazy run. And that's fine. That's the thing. Like you can be right about something. The executions matter most. And then here, poor Leopold, maybe he was feeling good. He was getting insane return after insane returns. But we're going to see what happened and then why the stock market dipped like that, because the balance sheets creates optionality. A forced seller, prime brokers, when clears transfers, Citadels evaluates packaging. So that's the thing. Like all the things that happen is like when you're forced to sell, you don't choose at what price you sell. There's nothing for you anymore. And that's the danger of leverage. A correct thesis cannot save a leverage portfolio when liquidity, crowding, and financings force the exit before the thesis plays out. And Citadel did not necessarily know the future better, but he had a balance sheet to survive the present. Now, there is some words about Citadel that we are going to explore that says that maybe they knew what would happen. So there's a good post by Amit that summarized this. Oh my goodness. I'm not going to do his voice. Citadel has bought the majority of the public asset from Leopold Situational Awareness Fund. So Citadel scares everyone on Tuesday about a surprise rate hike during FOMC that we all knew was not going to happen. On Wednesday, the entire market freaks out about the rate hike, which causes the selling to compound on itself, creating 50 to 70% drawdowns across the board in high beta semiconductors names, which means Leopold, who we now know had 45 billion of assets and was 400% leveraged, ends up being the sacrifice as it gets liquidated at what theoretically could be the bottom due to not having the margin requirements to keep solvent. And the person who caused the sell-off with the rate hike fears ends up coming in to buy his asset for 40 to 50 cents on the dollar. By the way, Leopold is getting married this weekend. I think he wanted to make sure that he wasn't getting margin call during his wedding. A vet on Wall Street in Ken Griffin takes out the young new kid. Absolute cinema. Man, I don't know about Odyssey by Christopher Nolan. I haven't watched it, but this is a good scenario. This is a very good movie. Like, we know they know how to do. Can you imagine just before his wedding? It's like so many things just goes in together that literally they trip him off and say, "Oh, don't worry, we can help you go back up." Crazy. Now, we will see how much investigation we get on this, how it will end up, but surely there is a lot to unpack. And now, if you're thinking like, "Oh, I should buy some," well, the thing is, the market recovered instantly, plus 16% here. We see SanDisk that is plus 20% or something like that. What about you? Who do you think created this? Let me know in the comments.